Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amaduri, and I'm joined today with another special guest. I've been trying to bring you the most up-to-date, the most relevant, the most informational guests here at Crush the Street and release these interviews on a very timely basis because things are moving very, very quickly in the markets. Literally trillions of dollars are being lost in the U.S. stock markets with asset values collapsing. We don't even know what the numbers are going to look like yet in real estate. I mean, it's just a slow moving market, but we got to assume that those numbers are going to be very devastating as well. We have unemployment coming up, and it's very important to be plugged into what is going on. So I have on the line Gary Christenson of deviantinvestor.com, a prolific writer and someone that you definitely want to tune into. And I think this interview is going to really shed some light on the amount of knowledge that this man has on the markets and the metals. And he's the exclusive writer, essentially, for milesfranklin.com, a very familiar bullion dealer. Many of you know them. Andy Scheckman, he's been on the show a number of times, and someone that I trust with my bullion purchases, and a great, honest place to get your metal. And so we're going to get real boots on the ground sort of insight as to what is going on with the bullion dealers here with Gary today and his take on the market. So Gary, thanks so much for coming on Crush the Street with me.
Well, thank you very much. I hope I can live up to that promo. Okay.
Gary, I just want to start here. We've seen so much go on in the markets. COVID-19 seems to be what's moving the markets at the moment. 1/3 of the U.S. is in a shelter from home mode, and that number is actually going up. It's one thing for a car to hit a speed bump on the road, but to be completely totaled, that car isn't going to be driven again. And let's just start here as it pertains to the economy. What sort of disruption is happening in this moment with COVID-19 and the extreme levels of debt that we're seeing surround us?
Okay, I think that's a very good point, but I really think there's two issues here that we need to address. Number one is the virus. Of course, that's really the catalyst, but not the primary problem, in my opinion. The virus is like you are driving that car down the road, to continue your analogy. And the virus is like, oh, we hit a nail in the road and we have a blowout. Maybe we don't have blowouts these days with our fancy cars, but in older days we had blowouts, and then the car rushes off the road and crashes into a brick wall. Okay, the brick wall is the fact that we're so leveraged and with so much debt in this economy that if we didn't have the debt, that would be equivalent to not having a brick wall there to crash into. A blowout is one thing, but a blowout that causes a car to crash into the brick wall is a whole nother thing. A coronavirus is a problem. Shelter in place, where you got 1/3 to 1/2 of the United States sheltering in place, not supposed to go out unless they're essential businesses or essential services, is a huge cramp on the economy. But it would be a great deal less of a problem if we didn't have so much debt. So much debt in the economy, so much debt in mortgage, commercial real estate, national debt, on and on and on. $75 trillion cannot be ignored. And that's one thing, but to go a little bit deeper, if you look at $75 trillion, you have to ask, what is backing up that debt? What is the collateral for that debt? And if the collateral goes bad, then the debt goes bad. And why would the collateral go bad? Well, if you can't service the debt, you don't have the cash flow, then you're going to go bad. I have a mortgage as an example on a restaurant. Or I should say I own a restaurant and I have a mortgage on it. I owe money on that restaurant as my example. What happens when I can't pay my bills because I don't have any business because everybody's sheltering in place? Now, what's the value of that mortgage? Has it declined in value? It's certainly worth a great deal less than it was before. Same thing with commercial real estate. The same thing with trillions and trillions of derivatives. What is the value of those things when the situation changes, and yet they were all originally based on reasonable interest rates and continuous cash flow, and we no longer have continuous cash flow? So we have that much debt demanding that much cash flow and that much service, and now it's not happening anymore. What does that do to the market? People get scared and they're frightened, and one can easily argue that the frightening overreaction to the virus is far worse than the virus itself. Now, from a medical point of view, we're not discussing that. I'm talking about from a financial point of view. But if you have a financial reaction that causes markets to crash, collateral to no longer be any good, we're in trouble because everybody needs that cash flow for that debt. So I'll stop there.
You mentioned the virus and the fear of the virus being
Mm-hmm.
more significant than the actual virus itself. Based on the amount of reading and research you do, I'm not expecting you to have some sort of medical opinion on this, but do you believe the COVID-19 virus to be much more an overreaction, the fear of this virus being an overreaction to the actual Main Street threat that it poses?
I'm not really sure I have an opinion on the reaction, the importance of the virus and the reaction that we're responding to that. You have on the one side, it's just a flu. On the other side, it's way more than a flu. My opinion is it's way more than the flu, and it's dangerous and it kills people. That's important. But what's really important is our government reaction to it is to shelter in place, to slow down the economy, to stop business, to stop progress. And that is a secondary reaction that has huge consequences for the economy. It's one thing if you just tell people to stay home. It's another thing if you tell them to stay home, they can't make their mortgage payments, they can't pay their credit card bills, they can't make their car payments, and then it escalates from there. And that's what I'm worried about, is the secondary and third level effects from the virus. The virus itself, from a medical point of view, is bad, but the financial aspects are something we can point to clearly. The medical aspects, I'll let the medical doctors debate all that. But the financial aspects, risky and serious and dangerous and getting worse as we go along.
So the Fed is doing everything they can to prevent a breakdown where there's still some flow of money so people can pay their rent, pay their mortgages, and keep things as normal as possible. Now, in a real reset, in a real correction, a real crash, which I don't disagree, or I don't think we're going to avoid, a lot of these situations would turn into bankruptcy. There'd be a transfer of ownership and a real reset, with people who have debt, and then the debt going away through bankruptcy and just a vanishing of capital. But the Fed is trying to plug these holes. Is there any sort of scenario that you see this playing out as? I mean, is everyone just going to continue to stay in their homes, and renters are going to still be able to pay their bills because of an injection into the system with the Fed?
Well, okay, I think that's a very complex question. I think that what the Fed is doing is, as you said, trying to plug the holes. We have hedge funds that are in trouble. We have corporations that are in trouble. And they have cash flow needs too. The corporations have cash flow needs. If that cash flow shuts down, their ability to make mortgage payments shuts down. Their ability to service their debt shuts down. These are all important issues. But to go back to, is the Fed going to plug holes? Well, they just passed $2 trillion, and I have Wall Street on Parade commented that there's $4 billion more or $4 trillion more to the Exchange Stabilization Fund, the plunge protection team. They're trying to fill the holes. They've enlarged their balance sheet since September of last year by over $900 billion. That's just straight QE. So they fed trillions of dollars of newly created dollars into the economy, into services, into mortgage-backed bonds, into treasury debt. If we were waiting on the private industry and private companies to buy the federal government debt, we might be in real trouble with interest rates. So the Fed has jumped in and is buying all this stuff. But what are the secondary consequences of all of these bailouts? What are the secondary consequences of feeding that much QE into the system? And to me, the consequences are fairly clear. We're going to have a lot more money circulating. We're going to have a lot more bankruptcies, because it's not going to completely solve the problem. It's going to fix a few. We're still going to have a lot of other people. Maybe we can bail out Boeing, but are we going to bail out all the workers who got laid off by Boeing? I don't think so. I think that we'll bail out Boeing, but there'll be a lot of people declaring bankruptcy, losing their homes, and so on. Just like in 2008, we had a lot of consequences there. And yeah, we bailed out the banks, we bailed out the mortgage-backed securities people, we bailed out some of the real estate people, but lots of banks and lots of people went under. We foreclosed on thousands of homes, and we'll probably do the same this time. And then the secondary consequence beyond that, with all that money in the system, we're going to have a lot more inflation. And there's the deflation and inflation argument. People will say all those bankruptcies will cause deflation. Yes, some asset prices will come down, and that's deflation. But what about living prices, the cost of living? What happens when we have not enough supplies and too much money circulating? We will increase the price of essential products for us to live. And that increase in cost is important. So that's where I think that we're going to have major consequences down the road.
Gary, there's a lot of talk about the Fed expanding their balance sheet, and you alluded to that. I mean, $900 billion in just a few months here, possibly going to $10 trillion. I know Mike Maloney had shared that in his latest video with the Fed's balance sheet possibly going to as high as $10 trillion. They're the largest holder of real estate, and we're in a world now with negative bonds. The 1 month bond and the 3 month bond are actually in the negative realm nominally, not inflation, not yield minus inflation. I mean, we're in real negative territory. And so how long can this backwards financial system go on for? And I know it's a kind of a follow-up to what we were talking about before, between every person in this economy being a card in this house of cards.
Well, good point. And to answer your question directly, how long can this last? I really don't know. That's a very difficult question. But let's talk about some of the ramifications of what we're talking about here. The Fed has increased their balance sheet by $900 billion. There's repos, all these repo things where they're creating money and feeding it into the repo market to bail out hedge funds and banks that are in trouble. But the $900 billion goes to bail out banks and goes to bail out the federal government's cash flow requirements. These things have consequences. And if you talk about the balance sheet going to 10 trillion as a number, and I've read in places where they're talking about the Fed is talking about QE of 125 billion a day. That adds up pretty quickly. What they're doing is feeding money into the economy, buying up everything in sight, whether it's bonds or mortgage-backed bonds or credit card-based bonds or whatever else, and trying to alleviate the problem of these assets failing. And then that causes downstream effects for the owner of the asset, who then doesn't have the asset they thought they had. It's all, they're just trying to prevent catastrophic waterfall, over the cliff kind of crash. And maybe they can succeed, maybe they can't. One could argue that they succeeded in 2008 because the world didn't end. And it was very risky at that point. But they didn't really solve anything. They just delayed it. This time, maybe they can delay it again, or maybe we're going to have a major reset where a lot of debt gets reset. That means massive bankruptcies, both at the corporate and the personal level, means that there will be a lot of assets that deflate down. People talk about the Dow dropping considerably more than we have here. There's a lot of parallels between now and 1929. And remember then the Dow dropped at that point like 89% over the course of 2.5 years. So there's precedent for a significant drop in the stock market and the Dow. One of the major differences between then and now is that at that point we were nominally on a gold standard. And now we're creating money by the trillions and funneling it into the market. So maybe we don't drop 90% in terms of nominal values, but maybe we drop 90% in terms of purchasing power. That's the point I alluded to before. You feed too much money into a system, you make all the money that's in that system less valuable. And let me just give a simple example. Say I have a $400,000 retirement account. bread costs $4. That means I've got 100,000 loaves of bread in my retirement account. Suppose the retirement account drops just to say 300,000, but suppose bread rises to $10 a loaf. Now I've got 30,000 loaves of bread in my retirement account. My purchasing value, my purchasing power dropped 70%. And yet that was not an exaggerated example at all. We could have the price of bread go far higher than that, and the price of the value of that, the nominal value of that retirement account go way low. That's what's worrying me, is the consequences of feeding massive amounts of money into the system. And it works fine for the people on the inside who are getting the money first, but what does it do to the man on the street who has to go to the grocery store and buy it, if it's even there? What does it do to him? It's hard on the person who's paying the bills. And that's a major concern in my mind when we start creating all this massive amount of money. So I'll turn it back to you.
Gary, let's talk about precious metals here in the
Mm-hmm.
moment. And I'll start off very simply. Just can you explain what we're seeing right now with gold, gold's role in this crisis? And has it performed in a way that you're satisfied with? Or quite frankly, do you expect more? Are you underwhelmed with gold's performance in this crisis?
Well, I think that a good parallel is 2008 in terms of gold and silver. At that time, gold dropped precipitously to like $700 an ounce, and silver dropped to some horrible number. I don't remember what it was, $8 or $9 an ounce. And then 3 or 4 months later, the stock market bottomed. But they dropped hard because people were selling people, meaning institutions and traders, were selling everything they could, including gold and silver, to raise cash to meet margin calls. You know, if you're raising cash to meet a margin call, you're going to sell what's liquid, and gold and silver were liquid at that point. So they sold them off, the prices fell down, and then not long after that, they skyrocketed. Silver went from what, $7 or $8 or $9 to 48, and gold went up to 1900 in the 2 or 3 years following that time. I think we're in a similar situation here. Gold and silver have fallen hard. Silver went down into the $12 range, and gold dropped several $100s, and now they're rising back. Silver was up $1 yesterday or so, and gold is up. They're rising back because those are paper markets. But look at the real markets. I checked APMEX today because they post online prices. Their price for Silver Eagles, which they admit will be delayed, was $26. $26 for $14 worth of silver, which shows that there's about an 80% premium. I think that's more realistic about what the prices for silver and gold are showing, is that on the paper markets, COMEX, the prices are down because you're just trading contracts there. But the real price of somebody who's got silver and got gold to sell is much higher, because they want a much higher premium, because they can't get people to sell the stuff to them, the wholesalers, unless they raise the premiums and raise the amount they're willing to pay. $26 for a Silver Eagle is an 80% premium. That's huge. Typically, you could see 10 to 15% premium, 25% in a worrisome market, and then it would go up from there. Well, what's to stop that price from going even higher as people get more panicked and more concerned about paper assets falling in value and real assets rising in value? Because what else are you going to turn to? I mean, you don't want to turn to a 3-month bond or a 1-year bond if it's going to be negative interest. Do you want to go to a 30-year bond that's paying 1% interest? Do you want to go to a 10-year bond that's paying 0.8% interest? Do you want to go to stocks that have fallen 35%? Or do you want to go to something real like gold and silver? Of course, you know, my bias is gold and silver, but I'm going to always side when you have a risky moment or a panic moment with gold and silver.
Absolutely. Well, and right now we're seeing some fissures in the paper markets, and we know that the paper markets have been very much levered compared to the actual physical supply. And maybe that's why we're seeing such a disconnect between the paper spot price and the physical demand, like you're pointing out there, the 80% premiums to actually get physical metal. And we've seen some news where there were liquidity issues happening in the futures market. And, you know, my question to you is this a moment for price discovery to take place in the gold and silver markets going forward here?
Well, I hope it is. I hope we have honest price discovery with honest money for real physical silver and real physical gold. Because all we've had for years and years, in fact, for about 5 decades, is price discovery for contracts of paper silver and paper gold. And the premium spread for going from 10 or 15% to 80% suggests to me that we're getting more honest price discovery, but it also suggests major liquidity issues. Now, I know that we've got on the COMEX and on the LBMA somewhere between 100 and 300 paper ounces for every real ounce that's available. I can't confirm the numbers, but they seem plausible because most of what's traded there is cycled silver and gold contracts. If we had those being 100% backed by cash or 100% backed by metal, so you couldn't sell a silver contract unless you actually had the metal, instead of just calling up and saying, I got the cash, I've got the mortgage, and sell me one contract. Then we'd find out what the real prices are. And that's coming. But we've been saying that's coming for 10 or 15 years. And maybe it's coming this year, maybe it's coming in a few years. I hope it's soon, because then we'll get honest prices on silver and gold instead of the dishonest prices or the fudged prices that we have, because we've got all of the paper contracts and all of the fake money that's used to buy and sell this stuff. A sign of it is that 80% premium. It could get worse. It could disappear next week. I don't know. We'll have to wait and see. But I'm hopeful that we'll get real prices for silver and gold in the future.
So you mentioned it disappearing next week. Now, do you see it more likely the spot price going to $22 and closing in that premium gap, or is it that premium gap going to $15? Or not above 15, not 15 plus spot, but wherever silver is right now, and being very close to the spot price.
I have a really hard time predicting day-to-day and week-to-week numbers, because there are so many factors and so many variables, and so much of the trading that's done on the markets, including stocks and bonds and silver and gold on the paper exchanges, is done by machines. It's very hard to predict what machines are going to do when there's news happening all the time, and they are at least primarily or oftentimes motivated by news. But if I look at the charts, what I see is silver and gold appear to be oversold and due to rise on both the daily and weekly level, and as is the stock market, by the way. It's horribly oversold. I would expect that the more likely scenario is for gold and silver to rise over the next several weeks. And in terms of long term, I think they're more likely to rise over the next several years, 2 to 5 years. But there's certainly going to be drawbacks and drawdowns and reversals. But I think that we should expect, with all the money that's being fed into the system, substantially higher gold and silver prices in the future. Because if you look back 5 decades, that's been the pattern. We have silver was $1.29 5 decades ago. We fed lots of money into the system, and it gradually goes up. And that's what we should expect going forward, except that the Fed is now pulling out all the stops and accelerating the process of money creation. So we should see substantially higher moves in gold and silver, and larger moves when they finally come. Next week, I don't know. Next month, I don't know. But I expect we'll see larger premiums and much higher spot prices.
Gary, and I know this is more speculation, but just maybe from what you understand of the markets, when it comes to an ETF like SLV, in a supply shortage moment, a price discovery moment in the paper markets, is it more likely for SLV to be repriced much higher, or do people panic sell SLV and it go down?
I don't really have an intelligent answer for that one. I just can't tell you what my opinion is on that. It's a good question, but I'm going to have to pass. I'd rather not speculate on something I don't understand that well, because I don't know what's really backing SLV. I don't know how much is really paper contracts and how much of silver is really there. I've heard stories that I don't fully trust or understand, so I'm skeptical of the answers. So I need to pass on that question. I'm sorry.
Well, no, not a problem, and I think it's healthy even for those listening to even ask that question for themselves to further understand what is going on in these markets, even if we don't have a clear answer on it. We know right now 25% of silver production has been taken offline because of COVID-19 stay-at-home measures around the world. I mean, Peru's down, Chile's down, Argentina's down. I mean, the supply disruption, it's being destroyed. I mean, this is seems like a real moment here for silver to shine.
I
And
agree.
I really hope that we have our moment with precious metals, silver and gold, because silver has just been, even with gold doing its thing, it's made silver look really bad going to that 125-to-1 ratio. I mean, people were really questioning silver's role in society. If it's just an industrial metal tied to the economy, then why own it if the economic outlook of the next while is going to be very bleak?
Well, why own it? Let me answer that one right away. Yes, if the economy is going down, if the demand for silver is going down because we're going into a recession, and a lot of people would argue we're not only in a recession, we're going into a depression. If the demand for silver is down, that weakens the demand for it. If the supply of silver is going down, because as you mentioned, 25% of supply is gone, that compensates for declining demand. But the real issue is, what's the investment demand for silver? If I have paper assets that have just declined 25%, and I'm scared that the economy is going to go worse, that they're going to revalue paper assets down further, wouldn't I want to put my money into something real like silver that has no counterparty risk? What's the counterparty risk of a derivative? What's the counterparty risk of a debt? What happens if I buy bonds and they're going to default? The counterparty risk is huge. There's no counterparty risk on a silver eagle if I hold it in my own hand. I think that is a minor problem during good times and a huge problem during crisis times. And we're now in a crisis time. So I think that you need to pay attention to the counterparty risk and to avoid that as much as possible. Buy silver, buy gold. Another point, I just read that 3 larger gold refiners in Switzerland, in the Italian side of Switzerland, have shut down because, in another place I read there were 4. But if the gold refiners are shutting down, that means the large kilo blocks of gold and the 400-ounce blocks of gold will become less available. More risk to the supply. That should drive up prices also.
Gary Christenson, everybody, of Deviant Investor and major contributor of Miles Franklin, bullion dealer, trusted bullion dealer. Gary, please share some closing thoughts here as we conclude this interview. And also, if people want to learn more about you, Miles Franklin, and Deviant Investor, please let them know where they can go and what they can expect to find.
Okay, well, for Deviant Investor, just go to deviantinvestor.com. And for Miles Franklin, you can just go to their website, milesfranklin.com, and click on the blog. I write a weekly article there for Miles Franklin. And then I post usually on Deviant Investor once a week also. Closing thoughts. We've just passed a massive bill, or we're in the process of passing a massive bill, a bailout bill. But ask yourself, who's really going to benefit from this bailout bill? How much are you as an individual going to benefit from this? How much is your retirement account going to benefit from this? How about your savings? And then ask yourself, who's getting the majority of the money, say 90% of it, the corporations and so forth that are looking for bailouts. Boeing wants 60 billion bailout after buying $45 billion worth of stock buybacks. So they need a $60 billion bailout now. Chances are they're going to get it. Their stock is up huge today. So they get a bailout. How much did that bailout do for you? But it did a whole lot for Boeing stockholders. Okay, so you're going to get a $1,300 check or a $1,200 check or a $1,000 check in the mail someday. And what's that going to do for you? Well, it's going to pay the rent that you couldn't pay because you lost your job or whatever. We don't know where all this is going to lead, but it seems to me that the person who's going to get hurt worst on this process with the virus and the downturn in the economy are the people who are on the bottom edges of the economy, who are living paycheck to paycheck, and who are worried about making the next food payment and worried about making ends meet. They're going to get hurt the worst, and I feel for them. I wish I could say take that $1,000 and buy silver coins, but I'm afraid they're going to need that $1,000 for something else. But to the extent that people can have liquid assets, I'm not sure it's not too late to buy silver, but it would have been better if you could have bought it 2 months ago. Always, but um, the debt assets, the value of the currency, we can know they're going to go down. They've been going down for 5 decades. They've been going down since the Federal Reserve was created in 1913. They're going to continue to go down. National debt is $23 trillion. It's going to skyrocket in the next couple of years because of all of the economy going down and the bailout bills that are being funded. All of that debt means the purchasing power of the dollar is going to flop around, but on average it's going down. And that means your prices for food and energy and whatever else you need, don't even think about medical care and college, are going up. So to the extent you can, protect yourself, protect your savings, and protect your retirement, and use what assets you have as effectively as you can.
Gary, thank you so much for coming on Crush the Street and sharing your wisdom with us.
You're welcome.